David R. Guttery is the president of Keystone Financial Services in Trussville, Alabama. David Guttery is a financial advisor who represents Emeritus Investment Company, LLC, and Emeritus Advisory Services. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone, I'm joined today by David Guttery, President of Keystone Financial Group here in Trussville, to discuss ideas about the management of portfolio volatility at this time. David, thank you so much for joining us for a timely topic. Well, last month you talked about how recent market volatility seemed rational in your opinion, but today, can you share some practical ideas with our viewers about how risk can be managed within investment portfolios?
Yes, certainly. Let me preface my comments, though, by saying that actionable investment advice can only be rendered following a comprehensive planning effort through which objectives are identified and risk tolerance is defined and a basis for investment direction is determined. At a high level, I believe there are three platform-level strategies that could help to offset market volatility at this time, and I'll discuss each strategy individually. The first strategy is to own a greater weighting in the stocks of the companies that produce economically durable products and services. Second, I would explore the alternative universe to general securities to seek negative correlation with the market and for the pursuit of income. Third, I would defensively employ the use of market options and option strategies. So again, this is not to be considered a recommendation to any of your viewers, and I would strongly suggest that anyone having an interest in what we're about to cover should consult with their investment professional before employing risk mitigation strategies.
Well, it sounds like there are many potential ways that people could seek to offset risk. So let's start with your first suggestion. What exactly is an economically durable product, and what is attractive about these companies?
Think of an economically durable commodity as being something consumed on a consistent basis throughout changing economic cycles. In general, this would include basic food staple items, basic pharmaceuticals, utilities, and other similar items. Very often, tobacco and alcohol prove to be durable staples during periods of economic softness. I am looking for companies that manufacture products that will be consumed durably, that I can obtain with a very low forward price to earnings multiple that will also provide a nice dividend back into the portfolio. During times of enhanced market volatility, I've placed a great value on steady, dependable streams of dividend income. The dividend yield can change, obviously, depending on the price for which the stock was purchased. That income, over time, provides stability to the portfolio as the markets reprice the risk of changing economic conditions. In addition to dividend income from equities, I would also suggest that sleeves of fixed income also be evaluated for credit worthiness and sector exposure. With the Federal Reserve in quantitative tightening mode, I believe that the risk of corporate issues on a shorter term basis with higher credits of quality could offer greater buoyancy to a portfolio than what can be found with treasuries. Indeed, treasuries seem to be much more volatile based in part because the Federal Reserve had previously been the single largest central purchaser of those issues with printed money over the last 2 years. Today, the Federal Reserve is no longer that largest single purchaser of U.S. Treasury debt, and there has been a great amount of price distortion resulting from the expansion of the Federal Reserve's balance sheet. To that end, for the first time in 50 years, treasuries and equities are moving in a positively correlated way. So I would seek to generate income from debt securities from sources outside of government issues for this reason.
Well, that sounds like great advice. David, you mentioned that a second strategy for de-risking a portfolio would involve alternative investments. Can you offer greater detail on this?
Yes. Typically, when we talk about alternative investments, it generally refers to such instruments as market-linked certificates of deposit, real estate investment trusts, limited partnerships, structured notes, among other things. Keep in mind that all investments carry risk, including the loss of principal. Market CDs are not FDIC insured. These products are complex and may not be appropriate for all investors. When I have employed alternatives such as these, it has been in an effort to streamline portfolio holdings, to build a bridge, if you will, between the dedicated fixed interest positions and the variable equity positions. These can offer unique sources of negative correlation, income, and hedges against market volatility. However, I would also include in the other tools of this category certain types of life insurance. These can offer guarantees of principal and tax-sheltered interest. Very often, we look to an instrument that we need anyway for indemnification and sometimes for long-term care for a third use as an external complement to what we maintain in fixed interest securities. Think of it as an external quasi-bond sleeve, if you will. Sometimes people overlook the tax preferential characteristics of life insurance, and it never occurs to them that such could also provide a principally guaranteed offset when viewed holistically. I would also suggest that equity indexed annuities could serve a similar role if there is no need for the life insurance tool. Again, this is just a summary of many alternatives that could be employed at this time to offset risk. I would strongly encourage your viewers to consult with their individual financial professionals to determine the suitability of any of these options with their objective-driven portfolios.
Well, so far these sound like great ideas for potentially reducing the risk that comes with remaining true to long-term investment strategies. Well, David, you mentioned a third approach that involved the use of options. Tell us more about this, please.
Sure. Again, this is a highly complex approach that may not be suitable for many investors. Market options are instruments that allow someone to control shares of an underlying stock. A call option provides the ability to purchase a given number of shares for a predetermined price over a specific period of time. A put option provides the ability to sell shares at a predetermined price over a specific period of time. Again, very high level example here, but if someone purchased shares of ABC Company but wanted to limit their downside risk, then we could purchase a put option with a strike price that reflected a 15% floor, for example. If the underlying stock dropped below the 15% threshold, then the put option could be exercised to sell that stock at a predetermined price where the 15% barrier was established. Within other strategies, we could build a collar around a stock position in an effort to generate income into the portfolio while addressing the need of downside risk protection. So in closing, we've often talked about planning being first, with execution being second. Objective-driven investment plans should be governed by a holistic financial plan, and remaining true to that plan should be the overarching goal. Having said that, many people have asked lately about methods for addressing risk at the execution level, and I hope that this high-level overview has been helpful. Again, I would encourage your viewers to engage their financial planner or investment advisor about what might be suitable and uniquely appropriate for their individual situation.
Well, David, as always, thank you so much for this information. And for additional information, David may be reached through the means listed upon the following screen. For the Trustful Tribune, I'm Brandon Dawkins.
David Guttery independently offers securities and investment advisory services through Ameritas Investment Company, LLC, member FINRA, SIPC, and Ameritas Advisory Services. Information provided in today's segment is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.